let's welcome in our guest for the show. I understand that we have Aishvarya Dadheech, who's a fund manager, Ambit Asset Management, joining us. Aishwarya, thanks for speaking to us right here on Markets Midday. How would you describe the kind of pressure that the market has been witnessing of late? How are you looking at where the direction is going to go from here?
Thank you so much. So if we see the last 1.5 months, we have seen a broad-based intense drawdown in the market. And we all know that the reasons basically are again the kind of policies which were announced in the month of July, and also the kind of earnings season which played out. And some bit of also has come in from the the risk of sentiment which is prevailing in the global market because of this currency wars and trade wars and the slowdown which is there. But what we see that now, what we believe is that this is more of an adverse sentiment which is now reflecting in the market, and the things which looks going ahead, especially talking about say this quarter which went by, we believe that quarter was not all that gloom and doom. There were resilience in the numbers which was reported by consumption sector, your private banks, cements, and even some infra names. Similarly, the way government is coming out with the policy to say reversal and other initiatives to boost the economy and create a conducive environment for the whole sector, I think this will bode very well for the economy as well as the market going ahead. And the third most important thing is, if you look at the global scenario where we are talking about the slowdown, we believe India is the only one which is almost like growing at 6%, and which will grow at this kind of a rate going ahead. And given the market valuations which looks like after this intense drawdown in the last 1.5 years, it's looked like that market has come to an attractive valuations going ahead. So though we have seen that some amount of money has been pulled out in the last 1.5 months, almost $3.3 billion of money has gone out, but I think with the way things are spanning on the global side and almost like 15 trillion of funds are basically chasing the negative yields, it won't be long that this money might start reflecting back into the global Indian market, and which will actually basically help the market going ahead. So going ahead, we believe this economic scenario should start improving, and the money will keep flowing. DIR anyway seeing good amount of momentum going ahead, and with the way liquidity scenario improves going ahead, we see better days to come in the next couple of quarters.
All right, nice to know that, and you're basically seeing things sort of move in the right direction going forward. Let's get a little sector specific here. Pharma is a sector that I want to focus on right here. On a weekday of trade, that sector in fact is holding on to some marginal gains. Sun Pharma, pull that up for our viewers right now, shining in trade, helping the index in staying in positive. The counter is surging. We're looking at gains of almost 3%. At one stage. Also, we've seen a Biocon as well as Divi's Laboratories both registering smart gains, about 2% there, followed by Glenmark and Lupin as well. Talking specifically about Sun Pharma, the stock is witnessing some pretty smart gains after the company got a clean chit from SEBI. The Securities Exchange Board in its prelim inquiry found no merit in the allegations leveled against the pharma major and said that the team believes this matter does not require any further probing. SEBI in fact had initiated an inquiry against Sun Pharma after a whistleblower alleged that corporate governance as well as tax related violations existed in the company. The whistleblower in fact has complained of a fund diversion and of personal profits that are being made, and we're talking about an amount of about 10,000 crore rupees. So we've sort of focused on these particular pharma stocks. Aishwarya, your take on pharma as well as the kind of activity we're seeing in the sector?
So we remain a bit cautious on pharma. We basically categorize pharma now after this US pricing issues, that any pharma company either have an higher exposure to US and someone which has exposure to other geographies including India. So we are more comfortable with companies with higher exposure to non-US, higher exposure to non-generics there. And second one most important thing is that though we have seen a very negative impact on the pharma stock prices, but at the same time we have also seen in the last 1.5 years that there has been an intense cut on the earnings side. So on account of that, the valuations are still not dirt cheap. The valuations are basically factoring in around 22%, 25% kind of earning growth, which is available at 20-23 times PE 1 year forward. Other thing which we are a bit cautious about, the way regulatory hurdles are keeping it among with most of the companies. There, if you name them, most of the companies have got either couple of their plants either stuck at all levels of the US FDA, and where we are seeing that things are not getting approved or on the ongoing basis, which might impact their running from FY22 onwards. So the long-term visibility is something which we are a bit caution about. We understand that the valuations, the prices has gone down, but then we have to look at the same time at the way how the earnings cut has been and how the earnings growing ahead. So we are basically more confident on companies which has non-US kind of a business, which has a non-generic kind of a portfolio, and where we will be able to see very high earning growth, and which fits the good and clean framework of our own internal frameworks.
Okay, fair points there, which is to sort of look at how the picture sort of pans out. This, of course, is a sector that one is looking at very carefully, given the kind of news flow that we've also seen. We're witnessing major pressure in this. We're talking about banking. Since yesterday, you've actually seen how that's been playing out. Banks, of course, very much on the radar at the moment. Almost all the counters have been trading in the red. Yes Bank is a top loser in trade, and it is also there with a fall of about 6%. Pull up an ICICI Bank as well as Federal Bank and an SBI that are registering losses of more than 2% each. Bank of Baroda, Axis, as well as PNB, IndusInd and Kotak Bank are all trading with cuts of about 1.5% each, that are followed by an RBL as well as HDFC Bank. Take a look at an IDFC on the other hand. IDFC First Bank registering smart gains of about 2% today as well. Aishwarya, I was talking to someone the other day who was basically quite concerned about the kind of banking stocks that they hold. These are all quality names that they had. They feel that they don't really know where the sector is headed and the kind of pressures that banks are going to be under directly because of the liquidity issues that we're looking at, as well as sort of policies that are coming in. How would you advise somebody who's holding on to banking, as well as, of course, a good strategy when it comes to financials?
So we are very optimistic about the banking space, including selective NBFCs. We believe that banking will continue to do well going ahead. The larger part of the pain has already been taken care of because of this NPA recognition cycle has already been factored in. Though there is pressure in the system because of the liquidity scenario, and there is some working capital pressure there with that SME and MSME also on the retail side, but we believe that things will gradually improve from here on the liquidity front, and we might not see very stark deterioration in the asset quality on the retail or on the SME or MSME going ahead. So we continue to remain a bit on selective good and clean banks, where we have a lot of comfort on the way the business is conducted, and especially on the liability franchise, and on the asset qualities numbers. So we believe those kind of banks are still available at quite attractive valuations, and similarly the story holds for quite a few NBFCs. In spite of such crisis of confidence of liquidity, we are able to see that some NBFC and select private banks have been able to report very good set of numbers, and though the commentary going ahead is a bit muted because of the uncertainty, but they are very confident internally that things will pan out well for them and the others. So what we intend to mention is that stick to the banking space, stick to the select NBFCs, but stick to the quality. The one where you have seen the most of the recognition cycle is taken over, where we have a lot of comfort on the leverage, the kind of capital that they have to get the kind of growth for the next 2 to 3 years. These are the opportune time to get into those good and clean banks and financial space with there.
All right, good time to be in, and this, of course, is the only way out. The only way forward is up. Let's just take a look at what's also happening in insurance at the moment. Just pulling up that particular space at the moment. Among the entire financial space, you can see how insurance is playing up. Those stocks are shining. The industry has been growing about 15%. We, in fact, had a conversation on this with the Managing Director and CEO at HDFC Life, Vibha Padalkar, who remains quite bullish on the rest of fiscal 20, and also expects the industry to grow parallelly. Listen to the commentary that we got in terms of their own growth strategy going forward.
We remain pretty bullish on the outcome of this financial year FY20. So right now overall industry growth is trending around 15%, and I would see it ending at a very similar kind of level. HDFC Life should comfortably beat industry growth. We continue to remain interested in case something of high quality comes onto the table. We have the currency, we have a strong balance sheet, but we will move ahead only very cautiously because we don't want to dilute the quality of business that we have built. Nevertheless, we will evaluate any opportunities that come our way.
Okay, once again, you're looking at commentary about industry that is actually going to only see better days ahead. Aishvarya, anything you have to say on insurance as a space?
This is one segment which we are very optimistic about in the long term. We believe that India has not even touched the iceberg, and the kind of penetration which will be there from 10 years, 20 years down the line will be humongous. So there is no dearth of growth in this particular segment, and there are very handful of players who have been able to crack this pie, and the private participation will anyway increase going ahead. So we believe that these are the segment which one should basically invest from a long-term perspective, and things will be very encouraging going ahead. So we are very upbeat on insurance sector per se.
Okay, so you're upbeat on insurance at the moment. Let's also talk about an FMCG, because that is a counter that's a sector, that's being closely watched. You're looking at the Nifty FMCG under pressure, with Tata Global being the biggest drag on the counter at the moment. In fact, that stock was down over 2%. After that, we're also looking at a Britannia that has also been down. ITC and Marico all are seeing cuts around 1%. UBL, Dabur and also Colgate, on the other hand, are holding on to some ground at the moment. In the meantime, we're also seeing the index that will see a new entrant to its list by the end of September. FMCG major Nestle India is all set to hit the Nifty 50, pushing out Indiabulls Housing Finance instead. The big concern, Aishvarya, with FMCG has been, of course, earlier the kind of valuations we had, as well as how certain counters that we were expecting more on because of this whole consumption story, as well as the rural sort of consumption story, didn't sort of come out as bright or aggressively as we had anticipated. How should one navigate FMCG? Is this a good time to go into some of these counters?
So if you look at, there has been a lot of talk on the way FMCG space, especially the staples, has performing because of the cyclical slowdown. But if we actually look at the data, the Q1 numbers reported so far, the FMCG staples composite growth has been around 6.2% on volume on year-on-year basis, which we believe is quite decent, given almost 7.5% growth for the whole FY19. So there is some sort of cyclical slowdown. But if you look at the companies, whether it is Colgate or HUL or Dabur, Nestle, they all reported very decent volume growth, given the kind of context which has been there, and given the kind of liquidity issues which is hampering their distribution side. And what we think going ahead, that the way monsoon has played out in the last couple of weeks, where we are sitting at almost like a number which is higher than the long-term average, and the way the commodity prices in the consumption space has been going down, we believe that this is like the companies will be able to manage the toughness in the market for the next couple of quarters on account of these two factors. And we continue to believe in the India story, and the consumption penetration, which will eventually grow up as our per capita income and the consumption savings goes up in the industry. So the kind of numbers that they reported, we don't have any reason not to believe that this momentum will continue going ahead. And just not about staples, even if you look at the discretionary side, where the likes of paints and all, they have reported almost double-digit volume growth. Even your tile players, pipes like the way of Astral or Supreme and all, they all reported decent numbers on their volume growth, and that is coming in spite of all those pressure on the distribution side. So we believe when the things improves on the liquidity side going ahead, say next couple of quarters, these all players will be able to report much better numbers going ahead. And on the valuation side, this whole thesis is always remain at higher valuation, because you can't just value FMCG on the base of next 1 year earning, where the ROE is almost 70, 80 to 100%, where we have seen this kind of growth and this kind of brand and distribution which cannot be replicated in a short period of time. We believe the valuation will stay going ahead. So if you believe that there is an earning growth of 15-20%, one should basically look getting into those consumption staple and discretionary side. But the point is, one should get only in the good and clean names, the one which are the market leaders, the one which have a strong balance sheet and clean corporate governance.
All right, so one should look out for all these factors, balance sheet as well as good governance. Thanks for this conversation. That was Aishvarya Dadheech, who is the fund manager, Ambit Asset Management, joining us on the show. Thank you very much for your views on what's happening in the markets at the moment. Let's also talk to you about Vinti.